Welcome to the Deep Dive. Today, we're tackling something, well, a bit startling about the Thai stock market.
Yeah, it really is quite something when you look at it.
The S8 index, right now in 2025, is basically at the same level it was, get this, 32 years ago, back in 1993, around 1,200 points.
It's hard to wrap your head around, isn't it?
Totally. I mean, think about everything that's happened in Thailand over 3 decades. Massive infrastructure projects, new industries popping up, modern life everywhere.
You'd expect the market to reflect some of that progress.
Exactly. So how is this even possible? How can the stock market have gone nowhere for so long?
Well, that's what we're digging into today. It's what a lot of experts are now calling an unprecedented period for the Thai market. Not just a temporary blip, but a slow crisis.
A slow crisis.
Okay.
Sounds different from what we've seen before.
It is. Fundamentally different. And our mission today really is to unpack the reasons behind this. We're drawing on analyses from, top investment gurus, financial strategists, looking at the latest data.
Right. The goal is to figure out what's really going on, give you some clear strategies, and maybe even find some surprising opportunities in all this.
If they exist.
Okay, let's start there then. This slow crisis.
Yeah.
You said it's not like past crises. What makes this time so uniquely challenging?
Well, think about the big ones we remember. Tom Yum Kung in 97. That was a shockwave.
Oh, yeah. Shook the whole region.
Exactly. Or even the COVID-19 dip more recently. Those were sharp, sudden shocks. Painful, yes, but they were followed eventually by rebounds, sometimes pretty strong ones.
Right. There was that feeling, if you were brave, you could buy the dip.
Precisely. This is different. It's more like a gradual, prolonged decline. Some call it a crisis of maturity for the market. The SETS index is down, about 40% from its all-time high?
Wow, 40%. It was around 1830, now hovering near 1100.
Something like that. And the key difference is the feel of it. In past crises, even the bad ones, there was often this sense of hope, a belief that recovery was on the horizon, clear opportunities for those who timed it right.
But not this time.
It seems much harder. Many seasoned investors, people who've seen it all, market gurus, they're saying hope is scarce. Opportunities are fleeting, if they see them at all. One expert flat out said he can't see opportunity this time.
That's quite a statement.
It tells you how difficult this period is. It's not a sharp drop and bounce. It's like a tide slowly going out and you're not sure when or even if it's coming back in strongly.
That image of the tide going out.
Yeah.
Yeah, that makes sense. So if it's not just a typical cycle, what are the deeper issues, the structural problems causing this slow crisis?
Okay, so the core problems are pretty deep-rooted. First off, Thailand's overall economic growth, the GDP, it's slowed way down.
How slow are we talking?
We're talking maybe around 1% per year on average in recent times. That's just not enough fuel in the engine, not enough broad economic expansion to drive really significant corporate earnings growth.
And that connects to the stock market how?
Well, here's the disconnect you mentioned earlier. Over the last 32 years, Thailand's GDP, the size of the economy, has actually quadrupled.
Quadrupled, okay.
But the S8 index, even if you factor in reinvesting dividends, which average around 3% a year, it's only gone up by a factor of about 2.6.
Wow. So GDP up 4x, market up 2.6 with dividends? That's a huge gap. What does that tell us?
It suggests a few possibilities, none of them great. Either the market today is massively undervalued,
Meaning prices should be way higher.
or the market back in 1993 was hugely overvalued, like a bubble. Or maybe it's a bit of both. But fundamentally, there's this persistent misalignment. The market isn't reflecting the economic growth that has happened over the long term.
And why the slow growth now? What's behind that 1% figure?
A big part of it is demographics. Thailand's population is aging rapidly and the birth rate is falling.
The aging society issue.
Exactly. Fewer young people, more older people. That generally leads to less overall consumption. It just makes it harder for businesses selling into the domestic market to find significant growth.
And it's not just demographics, is it? What about the types of companies in the market?
That's another critical piece. Look at the top 10 companies on this essay. What do you see?
Banks, energy, telecoms, airports, big established players.
Right. Traditional businesses. Compare that to, say, the U.S. market. What dominates there?
Tech. Apple, Microsoft, Google, Amazon.
Precisely. Technology-driven companies, innovators. That composition makes the Thai market look, a bit old-fashioned to global investors hunting for high growth.
Because these big Thai companies have already captured most of their home market.
Pretty much. They're mature, they've saturated the domestic market. Finding big new growth drivers is tough. And often, the new things people are spending on, like, say, Netflix, that money flows out of Thailand, not into listed Thai companies.
So global investors are looking elsewhere.
Increasingly, yes. Thailand isn't seen as the prime destination it once was. Capital is gradually withdrawing. We're seeing markets like Vietnam being called a star now, with huge potential.
Vietnam, right?
Ugh.
Younger population, manufacturing hub.
And India, too. They're attracting the foreign investment that maybe would have come to Thailand in the past. It suggests the Thai market might become more of a local play.
Which implies less fuel for growth overall.
It does. And tackling these deep issues, the slow growth, the demographics, the business mix that really needs strong government leadership, effective policies, promoting innovation, boosting efficiency, it's a big task.
Okay, this picture. It sounds incredibly tough for the average person invested in the market. People must feel really stuck.
That's exactly what the data suggests. There's a huge amount of capital effectively trapped right now.
How much are we talking?
Estimates suggest Thai investors are collectively stuck with shares worth something like 1.3 trillion Thai baht.
Trillion, wow.
And retail investors, everyday people, have added around 500 billion baht to that pile just since the COVID pandemic started.
So people bought in, maybe hoping for a recovery, and now they're underwater.
Many are. And this creates a really dangerous situation. The temptation is to make impulsive decisions based on fear, especially when the market gets volatile.
Like panic selling at the bottom.
Exactly. Selling when prices are lowest locks in losses, and you miss out on any potential rebound, however small, plus future dividends. There's that famous JP Morgan analysis.
I think I know the one. About missing the best days.
That's it. Their guide to the markets shows that missing just the 10 best trading days over a 20-year period could slash your total returns by as much as half.
50%.
Yeah.
Just from missing 10 days. That's incredible.
It really highlights the danger of trying to time the market, especially driven by emotion.
So even if some stocks look cheap now with low PE ratios, that might be misleading.
It often is. A low PE, that's price to earnings, might look attractive, but in this environment, it frequently reflects the market's expectation of declining future growth.
So it's cheap for a reason, a potential value trap.
Precisely. It's not cheap like a bargain. It's often a signal that the market thinks the company's best days are behind it growth-wise. We've seen plenty of former super stocks, companies everyone loved, see their prices crash 50%, even 80%, even when their earnings looked okay initially.
Ouch.
And adding to the worry, there are concerns sometimes that market upticks aren't even organic. Remember the Vayupak Fund activity back in October 2024?
The government investment fund stepping in?
Yeah. The worry is that such actions can artificially pump up prices, only for them to fall back later, maybe even below where the fund bought in, causing more losses for regular investors who followed.
So you definitely can't just blindly buy the dip anymore.
No, that strategy seems much riskier now. The underlying dynamics have shifted.
Okay, the old playbook is out.
Whew.
Given all this stark reality, what's the big mindset shift investors need in Thailand now? And what practical strategies can you actually use?
The absolute crucial mindset change is this. You have to largely abandon the traditional growth stock mentality for the Thai market.
Meaning don't primarily invest, hoping the share price will shoot up rapidly.
Exactly. That kind of capital appreciation is likely to be much harder to come by across the board. So the focus has to shift.
To what then?
To income, to dividends. Since overall stock prices aren't expected to rise dramatically, investing in stable companies that pay out high, reliable dividends becomes the primary strategy. Think cash cow.
A cash cow strategy, focusing on the income stream rather than just price growth. Are there specific types of stocks that fit this?
Yes, the Set High Dividend Group, the SETT stocks, are worth a close look. As of, say, late March 2025, these stocks generally had better numbers.
Better how?
Well, higher current earnings per share, or EPS, like 121.7 baht versus 95.1 for the overall market. Better expected future EPS, too.
So making more profit now and expected to continue.
Right. And importantly, they tend to have more attractive valuations, a lower PE ratio, maybe 9.1x versus 12.1x for the market, and the big one, a significantly higher average dividend yield.
Okay, what kind of yield difference are we talking?
Around 5.9% on average for the SETT group, compared to maybe 4.4% for the broader market at that time. That difference is substantial.
Yeah, 5.9%. That's a solid income stream just for holding the stock.
Can you give some examples? Sure. Looking at recent data, you might see names like RCL with over 11%, CRI over 10%, Spaylight near 9%, PT TEP over 8%, Tisco around 7.8%, PTT maybe 6.5%. K-Bank over 7%. Yields fluctuate, of course, but those kinds give you an idea.
Banks often come up in this context, right? Even if their growth is slow.
Yes, banks are often seen as core economic pillars and relatively reliable dividend payers. Historically, yields have been in that 4-9% range. Stable, if not spectacular growth.
Are there specific stock tips floating around based on this dividend strategy?
Well, one strategist, Prakit Sirawat had some interesting takes. He suggested PTT could be attractive below 30 BAT, offering maybe a 7% yield. Bangchak, BCP, seen as a solid energy play, best bought on dips.
Okay.
And AOT, Airports of Thailand, potentially a long-term contrarian play if the price gets down towards, say, 25 baht, but that depends on clarity about its contracts.
So selective buying, focusing on yield and price points. What about general strategies?
Dollar cost averaging, DCA, is still your friend in volatile markets like this.
Investing a fixed amount regularly, regardless of price.
Exactly. It smooths out your average cost and reduces the stress of trying to time the market perfectly, which, as we've said, is extra hard right now.
Makes sense. What else?
Regular portfolio checkups. You need to review and rebalance your assets, maybe semi-annually or annually at least. Make sure your risk level is still right for you and aligned with your goals, which might be shifting towards income.
And maybe adding some stability.
Definitely. Incorporating things like government bonds or money market funds can provide ballast, reduce overall risk, and give you some stability when stocks are choppy.
What if your portfolio is already full? Just hold on.
Not necessarily. For investors who are fully allocated, it might be time to prudently sell certain stocks. The ones that seem to have really poor prospects, the no-future stocks.
To free up cash.
Yes, not panic selling, but strategically trimming positions in structurally weak companies to redeploy that cash into potentially better opportunities, perhaps these higher dividend payers, or even looking outside Thailand.
Okay, that's a good transition. If the Thai market is facing these deep structural shifts, does that mean you absolutely need to look beyond its borders? What are the alternatives?
Diversification outside Thailand looks increasingly sensible, yes. First, think about protecting your capital.
How so?
Consider reducing holdings in Thai baht itself. Parking some funds in stable foreign currencies like the US dollar or the Swiss franc, or even in gold.
As a hedge against what?
Against potential baht depreciation. If Thailand keeps running persistent trade deficits, the currency could weaken. These assets can offer some protection.
Okay, so currency diversification. What about investing in other stock markets?
Well, as we touched on, global capital seems to be shifting maybe away from some developed markets towards emerging markets. So allocating some funds to stock markets in, say, other parts of Asia or Latin America could offer diversification and potentially new growth avenues.
Where specifically looks interesting?
The U.S. market often comes up as potentially easier for trading, given its dynamism and innovation, especially tech. And again, Vietnam keeps getting mentioned as a strong growth-oriented market. It's benefiting from manufacturing shifts, has favorable demographics. It's definitely on the radar.
Any other areas within finance to watch?
One thing to keep an eye on domestically is the corporate bond market in Thailand. It's grown huge, maybe 15 or 16 trillion baht now, much bigger than during the 97 crisis.
And why is that significant?
It could become a new source of financial stress. Companies constantly need to refinance or roll over this debt. If conditions tighten or investor confidence wanes, that could become difficult for some, adding another layer of risk to the system.
Okay. Lots to think about there. So let's try and pull it together. The big picture is the Thai stock market is in a kind of deep, structural, slow crisis.
Yeah, that seems to be the consensus among many analysts looking closely.
And that demands a really fundamental shift for investors, moving away from chasing fast growth.
They're focusing much more on stable dividends, on income generation, on intrinsic value.
The whole landscape has changed, hasn't it?
Yeah, it really feels like it. Irrevocably, perhaps. So the question for you, the savvy investor listening, isn't just about riding out a storm anymore.
It's about recognizing this is a new reality.
Exactly, and adapting to it. So the final thought is this. Will you adjust your strategy, prioritize that stable income, maybe seek real growth in these new frontiers we discussed, or will you risk being left behind in a market that just doesn't seem to be playing by the old rules anymore?